Welcome to our monthly CIO Talk. I'm here with our Chief Economist and Regional CIO Americas, James Sweeney, to discuss recession risks, our investment positioning, and risky assets. James, on risky assets, the investment committee made some changes to its views in its last meeting. Can you give us some background?
Yes, the committee decided to go overweight on equities, and this is obviously an important change. It's because of some incremental improvements in a number of data and number of developments which have been weighing on the market. In particular, the large decline in yields that we've had recently has made the equity risk premium very large. So in other words, underlying earnings growth suggests the return on equities should be far above what you can expect from the bond market recently, given the low yield environment. In terms of growth, we think that global manufacturing and trade growth, which has been very depressed in the last year, is likely to do a little better in the next year. And some of the political developments with regard to the tariff announcements, Brexit, and Europe have been incrementally positive as well. Although the equity market hasn't been down this year, it's actually had a pretty good year. The internal performance is suggestive of a risk-averse equity market, and we think a lot of investors worldwide are somewhat underweight or underexposed to equity risk, and they're likely to move into the stock market in the months ahead. Concern
remains in markets and among investors that a recession is on the way or already here. As Credit Suisse's chief economist, what is your assessment?
Yeah, I think recession risks are elevated compared to recent history, but that doesn't mean they're high. So we don't expect a recession in the US in particular anytime soon, or really a global recession where we see many recessions at once. Really what a recession looks like is a sharp deterioration of the labor market, and in particular rising unemployment. We've seen no signs of that at all in the US. Jobs growth continues to consistently and steadily beat working age population growth. Labor market's tight. Wages are rising, but they're not rising so sharply that it's creating inflation risks. Some of the other things that we worry about with recession risk are stretched balance sheets by households or corporates. We don't really see that. Corporate balance sheets are slowly deteriorating, but not in awful shape. Household balance sheets are okay. So, small recessions in some very trade-sensitive economies around the world are possible during the manufacturing slump and the trade war. But for the US, at least in the quarters just ahead, we think the risks maybe implicit in the bond market at the moment are overblown.
How does Credit Suisse's current investment positioning overall reflect this outlook, and what do you recommend to investors?
Well, in addition to being overweight equities, we're actually underweight fixed income, and yields tend to rise when a global manufacturing growth and trade growth is picking up and when recession fears are receding. So I think it's natural to be underweight fixed income and overweight equities when you think global growth is set to reaccelerate after a deep slump. And believe me, when you look at trade, manufacturing activity globally for the past 12 months, it has very much been a deep slump. Then when you add in lots of policy easing that we've just had, an ECB cut this week, more QE from the ECB, we think the Fed will cut twice more this year, which means another cut in September and a third cut probably in October or December. That's a lot of stimulus being thrown at the market. Also, the views of potential fiscal stimulus in some places, but notably Europe, also are getting more optimistic. So I think that the policy backdrop, as well as the slight scaling back of some of the risks I've mentioned earlier, including the trade war situation, are quite consistent with the committee's views.
Many thanks, James, for taking the time.
Thank you.